Inflation has trended higher in 2022, affected by both demand and supply factors. Input costs increased sharply amid high global commodity prices and prolonged global supply chain disruptions. This was worsened by other cost pressures, such as the strong US dollar, which contributed to higher import prices. As featured in the EMR 2022 white box on exchange rate pass-through to inflation, a 5% change in the ringgit US dollar exchange rate is associated with a 0.2 percentage point change in core inflation over a year. Nevertheless, administered price measures and stable firm pricing behavior would limit the extent of exchange rate pass-through. Higher input costs also coincided with strengthening demand conditions following the reopening of the Malaysian economy, which enabled larger cost pass-through to consumer prices by domestic firms. On spending, apart from official statistics, you could see for yourself evidence of the strong retail activity, long queues at eateries, crowded shopping malls, and busy roads. So these are some of the demand factors we have spoken about. This is consistent with the insights from our on-the-ground surveillance undertaken by our respective regional offices. So we have seen some moderation in inflationary pressures over the past few months. Headline and core inflation rates have both moderated from their respective peaks in 2022. Cost factors such as global commodity prices and supply chain disruptions have eased and would continue on a moderating trend in 2023. However, we are mindful that input costs remain high. At the same time, the continued strength in domestic demand and improvements in labour market may keep core inflation elevated in the near term. Balancing these factors, we expect both headline and core inflation to gradually trend lower over the course of the year, but remain relatively elevated compared to historical average. For 2023 as a whole, headline and core inflation are expected to average between 2.8 to 3.8%. On balance, risk to inflation remain tilted to the upside. Input costs could increase further, arising from disruptions to global commodity production and exchange rate developments. Stronger than expected demand from China could also stoke price pressures. Domestically, the magnitude and timing of subsidy rationalization would also determine inflation outcome. On the other hand, a downside risk to inflation include weaker global growth conditions and faster dissipation of pent-up domestic demand. Nevertheless, the extent of upward inflationary pressures would continue to be partly contained by existing domestic price controls and subsidies. So let me now turn to the favorite subject, monetary policy. The MPC raised the OPR gradually last year through a series of 4 adjustments. This brought the OPR to 2.75 by end of last year, which is still below pre-pandemic level. The calibration in monetary policy support was necessary as we were no longer in crisis. It is also important to avoid a too low for too long interest rate environment to mitigate a build-up of future risks. The OPR adjustment were also meant to preemptively manage demand-driven price pressures from becoming excessive. Such risks, if left unchecked, could be damaging to the economy and cause deep hardship for everyone, individuals and businesses, as what we have seen from the experience of some advanced economies and emerging market economies. Given that monetary policy works with a lag, the recent pause allows the MPC to assess the impact of successive OPR adjustments on growth and inflation. So far, domestic financial conditions remain orderly, and we have not seen signs of excessive tightening in consumption and investment activities. Meanwhile, as I have mentioned, we are seeing a gradual moderation of inflationary pressures although inflation is expected to remain elevated. For 2023, monetary policy will remain focused on ensuring price stability in support of sustainable domestic economic growth. Ultimately, further monetary normalization will be informed by evolving global and domestic conditions. The MPC remains vigilant to factors driving inflation, including those arising from financial market developments, which could shift our assessment to the inflation outlook. We are also mindful of the risk that price pressures could last longer than expected, especially if upside risks materialize. This is why it is important for us to stay attentive to how inflationary pressures will evolve in ensuring sustainable growth. We do acknowledge that this is a delicate balancing act, especially in the context of this uncertain economic environment. With such consideration in mind, there is potential for the degree of accommodation to be further adjusted. But as I said, it will be informed by the evolving conditions and their implications on the overall outlook of domestic inflation and growth, which the MPC will assess at each meeting.